Good morning. Thanks for coming out early. My name is Alec Davis, and I'm with PitchBook News, based in San Francisco, and I'm very honored to be asked to do this panel with you all today. Joining me to talk about the issue of GP-LP relationships are my panelists here. We've got Jamie Rode. Jamie is a partner at Screen Door, which is a fund of funds that backs emerging VC managers. Previously, Jamie worked for over 8 years at a single-family office, sourcing deals and doing due diligence while focusing on emerging venture managers, private equity, and hedge funds. Jamie's based in Philadelphia. Can you hear me okay? Yeah. Asaf Zentler is the University of Miami's interim chief investment officer. He leads the university's treasury functions, and he works closely with university leadership on financial markets, liquidity, debt management, and endowment pension asset management. And in previous roles, Asaf has been an investment banker with JP Morgan. He also worked at American Express, Fisher Jordan Consulting, and Ernst & Young. So I think at the bedrock of the way that private funds operate is the partnership with their limited partners, their investors. So we're going to talk about what that partnership looks like in an ideal state, what a true partnership is. And that's going to cover issues ranging from liquidity to investment strategy to fee management, all those things. So let's start with you, Asaf. Talk about what an ideal collaborative partnership looks like in that context. And you can pick any one of those. We'll delve into a couple of those specifically, but just kind of at a high level, what are you looking for in a good fit for you and the GP that you're evaluating?
Yeah, thank you. Nice to be here. So for us, the basic has to be somebody who can generate returns net of fees that are above our threshold, right? That's before anything else, before we align on fees, before we align on terms, before we align on strategy. It's just your ability to do a replicable strategy that ideally isn't dependent on one single person. Now, that's tough to say because a lot of these firms have been founded by superstars. But over time, a lot of these funds now, the life of these private funds, after all the extensions in them, can go to 12 and 14 years. You don't necessarily know who's going to be there throughout the 14 years, but you do want to know that the strategy is there, that the functions are there, that there's a vision. And so for us, the first thing is somebody who is proven to do it. It doesn't mean he did it or at the same firm that they are in today. They could have done it in a different place, in a different strategy, in a different market. But a lot of times, these people are the ones who are able to generate continuous returns. And so for us, this is number one. We then deep dive into the fees, into the terms of structure, and we'll get into all of that topic on how we create alignment, which is extremely important for us to make sure we're aligned. And if they win, we win, and it doesn't go the other way where it's just one-sided. And so that's the next thing we dig into.
And Jamie, how do you advocate for your side of the partnership, and maybe talk about what the role is of a LP advisory committee in that sense?
Yeah, I think it's really important when you're digging into an opportunity set to understand what their why is. I mean, I work in venture, and there's thousands of venture funds out there, but in my prior role looking at all these other asset classes, at the end of the day, we're all in it for returns, and if you're a taxable LP, you have to layer in taxes. Our big thing at Screen Door is tell me about your lived experiences, professional or non-professional, that give you the right to be the best at sourcing, selecting, and winning. What edge have you created in the market versus everyone else out there? And so if you don't give me a strong answer for that, you're not worth my time, even whatever your track record is, because candidly, I come from a place where figuring out if it's skill or luck, it's kind of hard to know when the feedback loops are really long in private markets. And so I don't mind if you're lucky, but I don't know when your luck will run out. And so I need to understand if you actually have some type of underwritable skill. And so once I get over that and I incorporate that into the due diligence piece of it, we really do align on fees. And I think the LPAC piece of it really comes into play post-investment, but beforehand.
LPAC being the advisory committee.
Exactly. The advisory committee comes into it post-investment, but that is part of the due diligence process. I mean, the legal agreements, they really come in handy when things go wrong. And in a portfolio or when you're investing in many funds, something will go wrong. Something will happen. Unfortunately, someone may get into an accident or there could be a breakup of the partnership. And so making sure you understand that and there's a marriage there, because when you're underwriting an investment, you're dating. And then when you sign that paperwork, the investment may last longer than the average marriage. And in venture, it's probably 15 years. In buyout or private credit, it's very different. But the advisory committee should be made up of a variety of investors that represent the full investor base. So if half of your investors are taxable, you should not be taking all the softs because they represent the non-taxable base. So it shouldn't automatically be based on check size. It should be representative of the investor base. But you can use them for legal disputes. You can use them for end-of-life fund management. Should I extend the partnership or not? Should I exit this position? And that can be representative of an endowment wanting the capital, but a taxable LP saying, hold on, I don't want the capital back. I have to go pay taxes and then put it to work somewhere else. And so distributions in kind could be more representative for them. Founder pay-to-play situations in venture. You really should be using them as a guidepost. You shouldn't be using them to make you a better investor. That's a red flag.
Asaf, anything you want to add there?
Yeah, I think it goes back to this alignment on it doesn't have to always be just about the potential to generate profit, because there's other considerations. I'll give you one example that for us is kind of like of an eyesore. It's when one of our private equity funds, and a lot of them do it more and more, exit into one of the portfolio companies into the public market. That company is now traded and the distribution is not being given back to us. And so we are paying 2 and 20 fees on something I can go buy for 1 basis point. And if it works well, then the manager is happy. But for me, at that point, I'm like, this is not the risk I've been signing up for. I get it. You may own a big chunk of the company. You don't want to dump it into the public markets. You don't want your LPs to liquidate it. Have a strategy. Some of these firms will be there sitting on private funds, will be sitting on public equities for years, collecting fees. The strategy may work out well, and I understand the vision is saying, well, we still think there's value in that specific position. This is not the right vehicle to be doing this. We have other pockets. And so it goes into, this is the type of diligence. You don't want to see that track record when you sign up, and then they come and will ask you, hey, we're raising a new fund. Do you want to join in that? Well, in my mind, you exited, but I didn't get the proceeds yet. And so this is kind of like another example of those instances.
Did their carry kick in when they exited?
Yeah, exactly. So that's the alignment we're talking.
Okay, we might come back to that issue in a bit if there's time, because I've got a question related to that. But first, about cash management. What are you most concerned about? Why don't we start with you, Jamie, when it comes to just setting expectations and finding alignment around cash flow and the investment time horizons? How do you find alignment on that?
Yeah, I think as part of your underwrite, you need to understand the opportunity cost of your dollar. And so that really comes into play around, when you're investing in a specific asset class, what are the long-term return expectations? What's the average time it takes to get your capital back? And then what's the average time it takes to close up the vehicle? And so, some of that's on the investor to understand what those expectations are, but then some of that's on the investor to incorporate that into their underwriting piece. Also, that's where the LPAC or the advisory committee can come into play to help manage those expectations, to say, no, it's time to close up this fund. or especially, if a lot of GPs exited the opportunity sets a couple years ago when the markets were open, they're probably pretty happy right now because we're in a dry spell and you're not getting liquidity out of there. Another nuance to the cash management piece is line of credits. GPs use line of credits to enhance their returns. It is really good for cash management. I don't want a GP to call capital for me all the time. That's not proper cash flow management. It should be quarterly capital calls on a rough estimate. But if you're using a line of credit to juice your return, to kick your carry in earlier, that's a problem. That's something that you should be looking forward to when you're making that underwriting investment and understanding how they're going to use that line of credit, because I'm in it for cash on cash returns. I cannot eat IRR. I can eat TVPI and DPI, but not IRR. And just having that experience to understand what you're looking for is really important.
I couldn't agree more. You need to understand why we came with the investments to begin with. It's not to show a certain return, but not have the cash behind it to support it. It's part of our asset allocation. We assume there's going to be a certain use of that cash. You end up using a line of credit and only calling your funds for a year and a half. Yes, the return on a percent-wise may look great, but on a cash basis, I've just wasted a couple of years waiting for that capital to be called. It can also go on the flip side. So in periods like this, where rates went up over the last couple of years, the markets are dry, there's not a lot of activity, some of these funds are reaching their last couple of years or month of being able to put these funds to work. You don't want them to do it just so they can check a box that they deployed the funds in an investment that they wouldn't have underwrote otherwise. It's okay to return funds to your LP. Tell them, look, none of this came up, couldn't find anything in our criteria. We as an LP would very much respect a fund manager that comes and gives you your money back, your commitment back, and tells you, well, I'll come back when I do see opportunity in the market. That's how you build trust.
All right, thanks. So let's turn to a trend, a topic that's really on a lot of people's minds in this event, which is the growing interest that private fund managers have in tapping the wealth channel and diversifying their base of investors beyond the traditional set that you all represent right now, at least. So can we just talk about the fact that there's a growing momentum around managers to bring in this more diverse base, and what kind of risk that might pose to misalignment as you diversify that base of investors? What kind of concerns might you have when you see that happening?
I would say that diversifying your investor base can always be a net positive. I think having differentiated perspectives involved can always help someone. But I think the challenge is, and we alluded to it earlier, around the liquidity piece. If certain investors want their capital back faster than others, when you make end-of-fund life management decisions or decisions around when to sell, that can lead to conflict of interest. So in early-stage venture, the long-term return is about a 25% CAGR, which means the last 40% of time or the last 20% of time produces half of your return. So if you have an investor base sitting there saying sell at year 9, you're missing out on half a return there, which 25% over 12 years, that's pretty attractive. That's about a 15-ish X return. And if you sell at 9 years, you just cut that in half. So some of that is on investors and some of that's on the potential GP to educate and make sure that they're taking the right capital base and that investor base is educated. Also, is the capital base sticky? I think I've seen this a couple years ago when the markets were hot. You had a lot of corporates create venture arms, come in, make commitments, and then when the funds came back to market, they didn't come back. And that GP had a huge gap in their capital base, which could be problematic to me if I invested and then all of a sudden they can't raise their capital. And so I think there's a huge benefit and a huge opportunity for the wealth channel to access the private markets. I think early stage venture offers unique returns and uncorrelated returns to the public markets. Buyout is a great way to have, steady state returns. The long-term CAGR there is around a 14%. But just making sure that that capital base is well educated on the returns, the downside, the upside, and the time to liquidity is really, really important, not only for the GP, but for that investor to understand their asset allocation.
I completely agree. What I would add in that sense is that these markets are huge. I don't know how many trillions the private credit market is today. Venture is obviously a huge industry by itself. Retail should have access to those markets. You cannot ignore it, and they should be able to access it and get the benefit out of it. It should fit in people's portfolio. The big challenge is going to be how do they deal with the fact we're used to it as institutional investors. We understand mark-to-market dynamics. We understand that these items are not necessarily traded on a daily basis. We understand all the liquidity constraint. We understand that a statement that you receive doesn't necessarily reflect the cash flow that you're going to receive at the end of the day. Not sure that that market is aware of all of that. And what I'm seeing, it may be good or may be bad, but I'm seeing, and Wall Street is great in finding ways to charge more fees on the same exact product. I'm seeing these talks now about doing a secondary public market for private investments. So you're kind of like going full circle from, okay, let me take these investments private because there's all these benefits of not having to report quarterly, not having to market daily. But now because the retail folks are coming in, they need that visibility. So now you're going to do a secondary trading market for private commitments, which is just a full cycle back to syndicated finance, syndicated investments, just in a way to cut 2 and 20% out of it in the middle. And so we got to beware on all of us as an industry on educating the retail customers what it means. There's a lot of opportunity that they couldn't get anywhere else, either by access to this market, applying leverage, using all the expertise of the private managers, but it comes with high fees, it comes with all the issues we just discussed, and you got to find a way to bridge that. And I'm sure, I hear Apollo is in talks on doing that. Somebody's going to find a way to do it. Hopefully they do it in an efficient way.
Okay, so that's a good segue for talking about the strategy of the fund. Funds are very well defined usually about what their focus is, what their strategy is, what the asset is. So talk about what happens when a manager of, say, an early stage fund is presented with, or even a seed stage, okay, and they have some kind of later stage opportunity. I'll just keep it simple here. What kinds of things do you think about when you are presented with an opportunity, or the GP is looking at opportunities like that? It's straying from the mandate a little bit, or maybe a lot. So, Jamie, what do you advise in that kind of case? And is there a case to be made for straying sometimes when a special opportunity comes along?
First, it has to see what your legal docs say, if you're even allowed to do it. Second, that's where the advisory committee usually comes into play. You want the GP to go to them and say, hey, this is an oddball case, but this is my underwrite expectation. I think we've seen in venture in particular, sometimes the later stage opportunities. So when I say seed stage would mean like the first check into a startup. So you're investing around a $10 million, $15 million valuation. At the later stage, that could mean an $800 million valuation, $1 billion valuation. My question to them is, and I always think in probabilities, is there still a probability weighted return expectation of getting a 10x? If you invest at the late stage, do you still expect to give me a 10x or return capital on the fund? I mean, at the end of the day, I'm here for the returns. And so you've seen in some areas, especially with AI, if you had the opportunity to invest at OpenAI or Stripe or SpaceX at an $800 million, billion valuation, of course, with hindsight, it's beautiful, would you have taken it? Now, I would have said, yeah, you better have taken that opportunity you passed. I mean, they're worth significant multiples on top of that. And so it depends on the situation. It depends on, Are you investing at the late stage in year 8 of your fund? Absolutely not. Are you investing at the late stage and there's still time to compound? Because again, the multiple comes over time. We need the time to compound and the return expectation. And I think those situations, you get a lot of insight into how that GP invests and their why and how they make decisions. Because at the end of the day, you have to understand their decision framework. And so sometimes they can be a great opportunity and it showcases their network, and sometimes it can be a major red flag and maybe why you don't re-up.
Yeah, I would add it goes to our first question about how do you choose your managers. So hopefully by this point they checked all the boxes. You believe their platform, you believe their skill set, you believe their ability to make the right calls. And so at this point, you want them to bring these opportunities for you. You know, not everything is going to be a cookie cutter type of investment. The issue with those, when you stray away from your original investment, is that in periods like this where exits are tough to come by for the last 2-3 years, these managers at this point, you've probably signed up for 2, 3, 4 of their funds. Fund number 1 is reaching the end of its life. They want to close it. The original investments want to close it. You will see some of these managers sell one position from fund number 1 into fund number 2. And that's a huge no-no in our book, because as an investor who's here supporting you and have been in your 3 or 4 funds, I don't want to be bailing out fund number 1 just so I can get a mark-to-market number on fund number 2 that doesn't mean anything. There's a reason why you have the time to do your investments, to get out of them. You're not supposed to sell it from fund 1 to fund 2. Not to talk about if you're only in fund 2 and now you're buying a position that you haven't invested in since it was a seed investment. Now it's in round 3 or 4, it becomes a way more complicated situation. These type of dynamics is, I think, what the retail market is going to have a tough time understanding. Why do I suddenly get a 20% hold in company X, out of my fund that completely doesn't fit the profile of what I signed up for? And that could happen.
And can you trust that valuation? Was it Fund 2 valuing it, or was it Fund 1 valuing it? Because there's a conflict of interest there.
So on valuations, I actually wanted to get into that since you mentioned it. The transparency and the visibility into the portfolio itself is a ongoing and just ever-present concern for all the investors involved. And so can you talk a little bit about what you're looking for in terms of really getting a sense of what the valuation of the portfolio is? And this is a particular concern, again, for the retail investors, whether they're educated or not. They, in order to figure out liquidity possibilities, you, of course, have to know the valuation.
I would say a pro of private markets is it's smooth volatility. I mean, in the public markets, you're mark to market daily, if not every second of the day, depending on what you're investing in. In private markets, your financials are audited once a year. So GPs have some discretion, and if you really look closely right before that fundraise, they may tick up certain valuations. In venture in particular, they tend to lean on the last valuation round, but you've seen the trend where if that company hasn't raised capital in the last couple of years, your auditors are going to come in and say you need to underwrite this company and provide what you believe the valuation is. I think a really important piece, and something we do here at Screen Door, is back these managers early on and institutionalize them, just because our investor base, endowments, RAs, family offices, get to build direct relationships with these underlying managers. And so we teach them around what should your quarterlies look like, your newsletter. You need to provide transparency, and it's a really opaque world, but the more transparent you are, the easier it is for that investor base to come back and underwrite you in 3 years when you really don't have that many marks to show, and you're supposed to take a whim and say, great, this is a good fund manager, but in venture it takes 8 years to get to a DPI of 1, and I don't have much more data. So I think that's part of the underwrite piece too, is telling the GP what you're going to need before you sign the subdocs, because if you tell them after, they may say, too bad. I have your money and I don't really care, which is an unfortunate situation. But having that transparency, that portfolio monitoring, getting more data than maybe what your, your financial statements show you around revenue, metrics, certain pieces of that, that's important. And those are things that you should be asking early on.
I will take the lens of an institutional investor, but my stakeholder, which is the university and its investments committee, is similar to anybody here who is a wealth advisor and have their own clients. You need to explain to them why the portfolio behaved the way it behaved. And so for us, a portfolio is heavily weighted towards public equities. We have an exposure to private, but very, very low compared to our peers. The large endowments in the US, the Harvards, the Yales, the Stanfords, have 40-50% of privates. We have a 65-70% exposure to publics. And so what does that dynamic do to our rankings every year compared to them? Last 2 years, when the public markets are killing it and the private markets are pretty much flat mark to market, we finished number 5 and number 7 in the US. One year that will come and privates are going to go up like they went in 21, we're going to be in the bottom of the list. We're going to be ranked number 90 or 100 just because of that one dynamic that I spoke about. Educating our stakeholders that this is a dynamic. Don't celebrate when you see us number 5 in the US, but don't cry when we're number 90 is something that this industry is going to have to be used to doing it because of those dynamics.
All right, thanks, Asaf. We've got about 13 minutes left. I want to point out there is a process for putting in questions for the panel, so feel free to use the Slido app for that. So you mentioned fees, both of you, at some point. Can you share any concerns you have about just how to get alignment on fees? Again, the diverse investor base can be a factor there. What kind of things come into play for you there? And again, how do you advocate for the fees that you think are reasonable?
Especially, I'd say, on the early stage venture side, the average fund size we're seeing is $50 million. So it's not like the big brand names were 2 and 20. Like, they're making more money on the 2 than they are on the 20. I mean, if you're a $10 billion fund, the 2 is pretty attractive. But still, even at the $50 million fund mark, where it's easier to 3x a smaller fund, they need to eat. I'm respective of that. And so I look at what the average management fee is over the fund life, because that's more reflective of more market trends. We've seen some fund managers front load the fees and then it really drops off later. The real concern I have in venture is around the carry piece. Only 20% of venture funds get a 3x net or greater, and 8% get a 5x net or greater. And if I'm investing in venture, I better be getting a 3x net or greater. Otherwise, I'm going to go invest in buyout or public markets and call it a day. And so the carry piece, there needs to be alignment there. And we've seen managers try to do 30% carry. And I've seen this in the hedge fund world where it's 2 and 30 or 3 and 30. At least those are liquid and you can fire those managers. But it's more important to make sure that there is alignment and maybe more of a hurdle piece where you want to earn 30%, will get me a 5x net or a 6x net, and having those negotiations early, but being educated on what the market is, because those fees will change based off market trends, and is it easier to fundraise, and is it not easier, and what kind of track record do you have, and all of that. So just being well educated, and in my personal experience, calling it out earlier in the process will get you ahead a lot further versus if you're doing it 3 days before the fund closes.
And but before you go to you, Asaf, for both of you, I want to bring into context the current environment. The fundraising environment is obviously tougher now, and there's an expectation, I think, on a lot of people's part, that in that environment, you have more leverage as an LP for getting the kind of fee arrangement that you think is more reasonable. But are you actually seeing that happen? Because we've seen some data that indicates that, at least in private equity, it's holding pretty steady.
I would just add that even when I was at the family office underwriting buyout and hedge funds and venture, finding other LPs that were underwriting the same fund was very advantageous, because my check size plus their check size is a lot greater and we have a lot more influence. And so if we could align on those negotiations before they happened, we actually had a greater impact, because typically every LP is in a silo underwriting that manager, and I don't know that Asaf is underwriting the same manager I am until we find each other at the annual meeting. So that's pretty challenging. We love community and bringing other investors in. That's part of our model, but it's really challenging to kind of make headway on fees unless you're a really, really big check.
Yeah, that my tip would be in a tough fundraising environment. And to your point, Alec, I haven't seen fees necessarily go down yet. It's the terms where you can have a little bit more flexibility. And what I want to see is that it's everything. There's no tricks, in row number 57 that, you can backdoor carry from 5 years ago, or you can recalculate based on a different set of scenarios. You want to have a standard set of fees, and if you want to charge higher fees, that's completely fine. It's a free market. You want to go for 3 and 30, ask for 3 and 30. We'll make our determination. Again, we want to see net return that is, depending on our standards, 3x, 5x, whatever it is. If we believe we can get that with those fees, that's fine. We don't want those terms to be hidden somewhere where line of credit is a very good example on how you may not get your return that you're expecting. So just be straightforward, and the market will do itself. Having all these tricks, we'll catch on to it. I'm not sure if the retail clients will be able to catch all those dynamics.
So I think you mentioned private credit there. Private credit is quite the talk these days across the private markets, and I just want to take a moment to raise what should people be thinking about regarding private credit. It is obviously very advantageous for kind of a proxy for fixed income. Have you thought that?
So the private credit is by far the product that I've been sold on the most for the last year. The amount of funds that are out there raising is incredible. I get it. It's a gold rush. This new industry came up. There's definitely interest. There's need for it. There's borrowers that need that capital who don't want to go to the syndicated markets. But it's obviously something that's building up so quickly. I think it was $100 billion maybe 10 years ago, and again, a couple trillions today, where the jury is still out on whether the market knows how to price those deals correctly. Are the terms really able to hold there like a typical public credit agreement that would be out there? Are the fund managers really able to mark to market what that means? I can tell you no. How is the end game of all these credits when it's not going to work out, gonna play out? There's going to be creditor on creditor aggression, and that's going to be all the time. Just when you think about the borrowers being sophisticated private equity sponsors and the lenders sophisticated private credit lenders, they will go after the last cent and will use each other if they need to. This is not a typical corporation who borrows and pays back. This is sponsor versus sponsor in a lot of these cases, which is going to make it, a bumpy road. You've seen one private credit manager, you've seen one. It doesn't mean anything about the rest of the industry.
For us when I worked for the family office, we found private credit unattractive. I think the IRRs were highly attractive, but I said it before, I can't eat IRR. And so on a multiple basis, on an after-tax multiple basis, it was not worth our time. The short-term nature of how quickly you're getting your capital back can be very attractive. We just found other avenues where the liquidity piece was more interesting, especially in the public markets. We could build a strategy where that capital that I needed could be paid out in dividends, or it could be done through a muni bond portfolio. We never touched private credit because it didn't make sense after tax.
So there are about a dozen or so private equity firms over the last several years that have gone public themselves. And with that has come, a different mix, a different set of factors, particularly just being public itself. What kinds of concerns should we have about the makeup of their portfolios? We see more evergreen structures coming into play, especially in that set. You mentioned, for example, the public equities. Taking on a greater profile in those portfolios?
Yeah, it's a phenomena that goes against the alignment that we just discussed so much about. And I don't blame them. A lot of these are the well-established large cap managers who see an opportunity to just NPV all the cash flows they're going to get from their fees over the next 15 years to today, and they can take a chunk out of it, which is great for them. But for us as an LP, we're still going to be there. If I just sign up for one of your funds, I'm still going to be there in 14, 15 years. I assume the guys who founded these firms are not going to be there. It's now a question, well, is your successors, given most of the value in the firm has been taken out now through this exit to the public market, are you really going to attract the best talent to continue this legacy going forward when they know that the prize is not there for them compared to where they could do if they go to fund their own fund, or if they start with a fund that hasn't gone public yet? It seems like it's a way to get these very mature firms into the market. And again, they're a business like any other business. They should be able to be traded. The market should be able to access them. It's just it loses a little bit of the alignment.
But should there be provisions in the LP agreement that are going to speak to that can cover the concerns that would arise from that?
That would be a good way to control it. I just doubt that the LPs have that power or the ability to organize against these folks that went public that are just huge at this point. It's not one LP is not going to be able to determine that for them.
Okay. Let's see. We have a few more minutes. Are there any questions out there? All right, we'll keep going. Getting back to the rise of the wealth channel, as you see more of that developing, and it's looking likely that it's going to pick up quite a bit, what kinds of things should you and your beneficiaries know about that? And what do you expect to change in the relationship between the legacy LPs and their GPs? In that, what do you expect to change in that relationship as retail investors add to the base?
I say for us, we work with RAs and family offices, and what we found versus our endowment investor base is it requires just a little more education because, at the end of the day, everyone wants to raise capital, but you want to have the right partnership. And so we wrote a white paper just to educate that investor base in particular around the return expectations, the duration expectations, the type of portfolio you need to build to properly capture the returns in venture. And I think, candidly, it's going to create competition. X venture fund, X buyout fund, X private credit fund will only raise so much capital. Some of these strategies really are capacity constrained. Not everyone is a Thoma Bravo. And so it's going to create competition at some point where the legacy LPs may not be able to get their allocation anymore because the wealth channel is such a large percentage of the capital base in that asset class.
Yeah, I agree with that. The only thing I would add is that I don't think it's going to make a lot of difference from the LP's ability to talk directly to the GP, express their concerns when they have concerns, push back on terms when it's relevant. I think the institutional LPs are going to be the one leading those conversations. The retail are going to be benefiting from that negotiating power. And so the one thing I would say is if you have a full retail-based GP who has only retail investors, that dynamic is not going to be there. And so as a recommendation to any retail person going into a fund, make sure you have enough LPs, legacy institutional, next to you that are pretty much, you could leverage their knowledge.
We have a question out here. Shout.
My name is Patrick Shaw with Rinder Capital. When you talk about investing in early stage emerging managers, I heard the point of difference maybe to why you should exist. When you talk about prior to Fund 4, we're talking emerging managers sub 100 million, what else do you look for in investing in early stage emerging managers?
Yeah, I think the why piece is really important, but at the end of the day, venture is a relationship game. It's unfortunately an access class, and so what is your access? So what are your networks? What are your sourcing? What can I control at the end of the day as an investor? Stage, sector, geography, network. If I can underwrite all of that and validate that through references that says you will be able to access founders at the first check, you will be able to access Stanford, YC, Bay Area, New York, you're able to access the top 1% founders in XYZ sector that you invest in. Those are things that give me confidence, but you need the network to be able to dig in and validate that. Because at the end of the day, I said it earlier, is it skill or luck? I don't know, because the feedback loop is so long. So can I go through and validate through my network, through the GP's network, your ability to access top 1% founders? Because if you don't capture the 2% of startups that turn into a unicorn, your return will look like an 8% IRR, and I could just go buy the S&P 500 ETF and be much happier.
All right, I think we better leave it there. Thank you so much, Jamie and Asaf, and thank you to the audience. Enjoy the rest of the conference, everybody. Have a good day.